Welcome to Chapter 3 on put options. In the previous course on call options, we saw the buyer's and the seller's perspective. And then in this course, we saw the buyer's and seller's perspective on put options as well. In this chapter, I want to bring all four of these options together. So we have four options. We have a long call, we have a short call, we have a long put and a short put. So first of all, I want to clarify something in the terminology that's different in the options market than what it is in the stock market. So in the stock market, when we say we are long, we are actually talking about buying a stock and expecting the price to go up and capture a profit. And on the other hand, if you're talking about a short in the market, we are talking about selling the stock first, and then when it goes down, we buy it back and then close our position. So that's the terminology used in the stock market. But in the options market, we use slightly different terminology. Long and short have different meanings in the options market than what it does in the stock market. So let's take a look at this and clarify this point first because it's important. In the options market, when we say we are going long, what we are really talking about is being a buyer of options. If we are a buyer of options, we are long that option. So we could be long a call option and we could be long a put option as well. If we are long a call option, we are bullish, and if we are long a put option, we are bearish. And so the opposite of being long a call option is being short a call option, and the opposite of being long a put option is being short a put option. So this part can be a little confusing for newcomers, so I want to take the time and explain this. So let's look at Apple. Its last traded price was about $608. It's been moving up. It reported blockbuster results. And so our at the money options are going to be close to the 610, the 605 or the 610. Let's look at the 610 for our example. The 610 call is going for about, let me change the layout here. The 610 call is going for about $26.80. And the 610 put is going for $28.85. So if we wanted to buy one contract of Apple on the 610 call, we are bullish on Apple. So if you see the risk profile, that's exactly what our risk profile looks like. It's a long call. We are bullish on the upside. On the other hand, if we reverse this graph, and if we become a seller of this option, we can see that we are bearish. So it's exactly opposite of the long call. So this is called a short call position. Similarly, if we are long a put, say the 610 put, then we are bearish on the stock. And if we sell the put, we become bullish. So those are the four basic strategies, and they are all opposite of each other. So I want to explain this and see how we can remember something like this because it can be confusing for newcomers. So I've prepared this slide, and the title of this slide is called Everything is Opposite. So we first start with a long call. When we are long a call, we've bought the call option and we are bullish. And the opposite of a long call is going to be the short call. So the short call will then be a bearish instrument because we've sold the call option, and it'll be the opposite of a long call. Similarly, if a long call is bullish, then a long put will be bearish. And that's exactly what it is because when we buy a put option, we are bearish on the stock. And if long puts are bearish, then a short put must be bullish. So everything is opposite, meaning every position has at least two opposites to it, and the opposites are its adjacent boxes on this slide. So long call will be the opposite of a long put as well as the opposite of a short call. Similarly, the long put will be the opposite of a long call and the opposite of a short put. And a short put will be the opposite of a short call and opposite of a long put. And finally, the short call will be an opposite of the long call and the short put. So one of the decision points we have to make when we look at these four different positions is which one do we choose? Because if we are bullish, we have two different strategies to implement. And if we are bearish, again, we have two different strategies. So which ones do we choose and when? So that's a decision point that you'll have to make. And basically what it comes down to is how bullish or how bearish you are on the stock. If you're, for some reason, for any fundamental opinion or a technical opinion, if you're wildly bullish, then you obviously go for the long call because you don't want to limit your upside profits. Similarly, if you're wildly bearish on a stock, then you would go outright and buy a long put because, again, you'll have unlimited profits as long as the stock goes down. But if you're unsure, then you could use the short call or the short put positions. Then what you need to do is put probability on your side, go out of the money and use a short call or a short put to implement your outlook. Now, again, so in the next module, we are going to get into spreads. There is an unlimited risk component of both short calls and short puts, but I don't want you to be alarmed by that because we can use spreads to mitigate those risks. But to remember these four basic strategies, it can be confusing, and the best way to actually remember this is to remember only one of them. So the most natural one to remember is the long call because that's exactly like buying a long stock or going long on a stock. The long call will be exactly like buying a stock. So we are bullish, we expect it to go up, and we can capture a profit by selling it once it's gone up. And once we remember what a long call is, then we know that a short call is just its opposite. And similarly, the long put will also be just its opposite. But whenever we are sellers of options, remember your profit is limited. And whenever you're buyers of options, your profit is unlimited. And once you remember one of them, you know that it has two opposites. There'll be one opposite on the same side, which is the call side, and then there'll be one opposite on the other side, which is the put side. And once you know that a long put is bearish, then you know that a short put has to be bullish. So this is a good way of thinking about these four different options. If you can print out this slide or keep this slide in mind when you're thinking about the four different options, I think it'll become clearer as you get more exposed to it. The next point I want to show is how we actually capture a profit and how we can estimate what will happen to our position. So let's just go back to our option chain. This is the June series in Apple, and we have a 610 call and a 610 put. If we buy the 610 call option, let's look at the call option first. We are going to pay a premium of $26.80. Our outlook is bullish. We expect Apple to go up, and if it goes up, we'll pocket a profit. But how exactly is this done? What is the mechanism and how do we do it? I'm not sure if it was clear in the previous chapter, so I'm going to go through that in a little bit of detail here. So we buy one contract of Apple of the 610 call option. Let's look at the call. And we're going to pay $27 for this option. Now let's say we were right and the price of Apple indeed has gone up and it goes up by about $10. So if it goes up by $10, how much will this option be worth is the question. Although we don't have an exact number, we can get an idea, and Apple has just started trading. The markets are just open. It's 9:30 a.m. Eastern time, and we can see that the Apple options are trading. Now the same $27 option is now going for $25 because Apple has gone down from $608. So our current at the money option is more closer to the 605, which is now $28. So let's change the strike price to 605, and that's what we have. So you just saw how if Apple went down by about $3-4, what happened to the option price. So similarly, if we bought this option for $27.60, now we are talking about the 605 call. If Apple goes up by $10, then the price of Apple will be close to 615 from where it is right now, which is at about 604. So we have the 605 call, which is now trading at $25.27. So if this were to go up, if Apple were to go up, of course it's going down today. You can see it's gone down by about $6. But if it were to go up, then by $10, then we can look at what the 590 call is trading for. And that's approximately, the 595 call, and that's approximately equal to $30.39. So you can see that this option would go up by about $5. And so if you bought it at $25.36, you paid $2,536 for this contract, and you can now sell it at $3,039. So that way you capture a profit of $500 and odd. Similarly, if Apple goes down by $10, we can see that if we look at the 615 call, that's exactly what our option would approximately be equal to. It's not going to be exactly the same, but it's approximately going to be equal to this price of $20.65. So this gives you some idea. And so if you were to close this position out, then you would incur a loss of $500, but you would close the position out. Similarly, if we look at on the put side, we have the 605 put trading for about $27.65. And again, if Apple were to go down by $10 to say 595, then what we do is we go in the money and look at what the 615 is trading for, and it's about $6 higher, and that's what Apple would be trading at approximately. So you would capture, again, you would capture a profit of, because you bought this for $2,765 and you would sell it for $3,330, and you would capture that $600 in profit. And if Apple were to go up, you can see from the 605, you can go down $10 and you look at the 595, and that's what you would be trading for. This is a mechanism by which you can capture your losses or your profits, and that's how you would do it in the options world. So that's as far as chapter 3 on put options is concerned. Hopefully you've gotten a pretty good idea of what call options are, what put options are, and you've also gotten an idea of what the buyer's perspective looks like and the seller's perspective looks like. In the next 2 chapters, we're going to cover time decay and implied volatility. These 2 factors are also very important in options pricing, and once we do these 2 chapters, we're going to cover the Greeks, which really puts everything together. The Greeks are the most important part because we have 4 Greeks for the 4 factors that impact option pricing. Once we've covered the Greeks, we've covered all the theory behind options. And so it's time to get into the actual trading environment from the next module onwards. But before we go into the next module, I want to cover 2 important courses in this module itself. One course will be on how busy professionals can take advantage of financial markets and option markets in particular. If you have a busy day job, then you don't have time to look at the markets, and you shouldn't have to, because you don't want to be worrying about your position. So we'll show you how you can structure some positions based upon your interests, whether you're interested in stock, whether you're interested only in options. Based upon all of these things, we can show you a few things there. And also I want to cover the advantages of options, why options are so powerful. I want to compare it to stocks and show you a couple of different things also in that course. I think it's a pretty important course, especially if you're a busy professional, you're interested in the markets, but you don't want to have to spend time on it. This is perfect for you. You can just take a brief look, half an hour in the morning or half an hour in the evening, And if you do need to make any adjustments, you can plan that. But most of the time, you shouldn't have to do that. On most days, you shouldn't have to do that. So that's the philosophy behind these courses for busy professionals. There's one in this module. There's one in the next module as well. And I think I'll include one in the advanced courses as well. So that's as far as this module is concerned. In the next module, we're going to jump into the actual trading platform. We'll look at these 4 basic strategies first. So the next module is called an options foundation series. We have to clearly understand how the 4 basic options work. And then we'll be jumping into the intermediate concepts where we look at spreads. Spreads are a great way to mitigate your risk, and we'll see how it performs that role. And then in module 5, I want to introduce a few important trading concepts. We'll be looking at various kinds of analysis. We'll look at chart analysis, volume analysis, technical analysis. We'll also look at what the VIX index is. The VIX index is one of the most important indexes in the market. And then I also want to talk about some of the softer elements required in trading the financial markets. It has a lot to do with trading discipline, your own emotion, and things like that. So I want to cover those topics, as well as all the pitfalls or all the challenges that you can expect in trading. Stocks or options, these concepts apply to both types of markets. And we want to show you everything, show you the good, the bad, and the ugly. That's our guiding principle at Hacker Trading. So it's a no holds barred. We're not going to hold anything back, and we'll be talking about all the issues in that module. And then finally, we have our advanced module where we will be covering strategies like the iron condor, calendars, ratio spreads, things like that. So this brings us to the end of this chapter as well as this course on put options. I'll see you on the next course on time decay. If you have any questions, please feel free to email us at info@hackertrading.com. Thank you.